Get the meeting going. Oh, man.
Wow.
You're under the spotlight now.
Yeah, boy.
Well, good morning, everyone. It is 10 o'clock, so we'll call the October 14th meeting of the City Employee Retirement System to order. Item number 2 on our agenda, we have 2 presentations today from a couple of our fund managers. Before they start, I'm going to introduce Patty Carolzak, who's a vice president with ACG, and I think she's going to do the introductions for us. So, good morning, Patty.
Good morning, everybody. As you mentioned, we have 2 managers coming in to present today. We have somebody from, 2 people from Wells Fargo and 1 individual from Wasatch. Both managers manage assets within the emerging market category, so non-U.S. and non-developed markets. Manage about 5% of your overall portfolio. Emerging markets, as you guys know, tends to be a little bit more volatile, so performance can go up and down a little bit more. So the allocation is much smaller. We just have a 5% target allocation there. And the 2 strategies are designed to complement each other. Wells Fargo Wells Asset Management is more mid to large cap, and then Wasatch tends to be more small cap oriented. So you will see differences in the performance results, but again, they're designed to complement each other because they're fishing from 2 different ponds, so to speak. So with that, I'll turn it over to Wasatch, and they're going to give an overview of the portfolio, just talk about, both managers, give an overview of the portfolio, talk about the market environment and where we think returns and what the outlook looks like for the emerging markets. Chuck?
Good morning, everyone. How are you? It's great to be here today. Thanks for having me. I'm taking my mask off because it'll fog my glasses and I won't be able to see anything. So, my name is Chuck Stolfa. I'm from the client relations team at Wasatch. You may be, you've seen my colleague Kitty Swenson in the past. Kitty couldn't make it today, but sends her regards to all of you. So I thought what I'd do today is just spend a little bit of time giving you an update on Wasatch, and then I'll spend most of the time talking about the portfolio and the outlook that we're seeing, if that sounds good. So we're going to jump ahead a little bit, Regina, to page 5. And just to give you a quick update on Wasatch and who we are. So we are a small cap focused manager. We have been in business since 1975. And that whole time we focused predominantly on investing in small public companies, both here in the US and internationally, as we do for the small cap portfolio we manage for you, for emerging markets. And as we do that, we have a very deep team at Wasatch. You can see some of the numbers on the bottom of the page in terms of our research team, 34 total research members. And then the tenure numbers is something we're very proud of. We tend to get people who come to Wasatch, and hopefully we give them all the tools that they need to come stay a long time and really add value for our clients over time. We think that longevity is really important to our investment success. So we have about 40 billion in assets under management. As you can see, that number has been growing both from the market being positive the last year or so, and then also we've seen quite a bit of inflows in a number of our different strategies. So we feel very, very fortunate in that respect. And let's go to page 7, just a little bit more about the team that manages your portfolio. Ajay Krishnan in the top left, he's the lead portfolio manager. As you can see, he's been at Wasatch 26 years. So when you think about international investing at Wasatch, Ajay is really our lead in that area for emerging markets. And our team really does work as a team. We are bottom-up investors, meaning we're building your portfolio one company at a time based on the quality of that company. So we're keeping in mind what countries we're investing in and what sectors, but mainly we want to build a portfolio of good companies for you. So our team works together. Emerging markets is a huge universe of thousands of companies. We feel like if we can build a portfolio of 50 or so companies, we can really do well over time. And so if you go to page 8, you can see a little bit about the strategy. And so we are looking for high quality emerging markets companies that we think can double their earnings over the next 5 years. And if we can find those companies, we think performance will follow and take care of itself. So the strategy has about $2.4 billion in assets under management. And we have about 52 positions in the portfolio right now. So you can see our range is 50 to 80 holdings. So we're on the lower end of that right now, a little more concentrated, just because that's what the research shows us. We have some really good companies. We think it's important to have bigger weights in those companies. So let's go to page 9, and we'll just touch base briefly on performance. We've had a good period of performance, both in the third quarter, as you can see there, year to date, and then beyond that. And as I'm sure you're aware, emerging markets had a period in there for several years where they really kind of went sideways, and we're starting to come out of that. And so this is an exciting time to be looking at emerging markets and to be investing in emerging markets. And probably the best way to start talking about the portfolio is to talk about it from a country's perspective. So I'm going to jump ahead a little bit to page 13. And this is the third quarter attribution by country. So it tells you which countries, what our weightings were in those countries, and then how they performed. And it actually spills over a couple pages, so you might need to flip back and forth a little bit. But you can see third quarter and the year would be very similar. India's been very strong. You can see we have a large weight there. Taiwan, Argentina, and Russia have also been areas of strength. But over the last year or so, emerging markets has really been kind of a period of winners and losers. So you have these countries here that have seen some good tailwinds. And if you go to page 14 and then even on to 15, you see some of the countries that have really struggled, like China, Hong Kong, Korea. And so I want to talk a little bit about those. And I'll start by comparing and contrasting India and China, because that really gives you an idea of what's going on with this winners and losers in emerging markets. Now, if you look at India, from an investment perspective, it's a country we really like. It's a very open economy, very pro-business. You have a growing middle class and a growing financial sector. People are being introduced to banking for the very first time in their lives. Very good controls in place in terms of SEC types of organizations. We really like investing in India for those reasons. It's also growing very quickly. Their GDP in the second quarter was 20% year over year. That's coming off of COVID, but still very strong GDP growth in that country. And so we see a lot of positives there. Earlier this year, you may have seen India in the news a lot because they had a very difficult COVID outbreak, very big spike, a lot of death there, a lot of sickness there. What's amazing about India is that it's a very resilient country. They accept hardship like that and they just work through it. And so we were very confident that that's what would happen, and that has in fact happened. India has bounced back from that episode. They're vaccinating 6 to 8 million people a day with COVID vaccines. They have really not skipped a beat, and the markets there have not skipped a beat. So we have lots of good opportunities to invest there in tech companies, financial companies, and then consumer, because you have so much consumer growth there. So long story short, we really like India, and that's why you see on page 13 that big weight there. About 32% of your portfolio is in India, and it's been a good place to be overweight because it's done well. So then let's contrast that a little bit with China. So China's been in the news a lot. Over the last 20 years, China has been a phenomenal growth story. The government has moved that country leaps and bounds in a short amount of time. But unfortunately, there were some winners and some losers in that. There were some people that really benefited, and there were some people that didn't benefit. And in the last year or so, the government has shifted from a growth at any cost model to what they're calling common prosperity. And it's this idea that they want to continue to grow, but they want everybody to benefit. And they've taken some very drastic steps to start to make that happen. The first thing we saw last year was there was a very large IPO for a company called Ant. And the company is run by a gentleman named Jack Ma, who's like a combination of Elon Musk and Jeff Bezos here. Very successful investor. He got a little sideways with the government, though, and they weren't happy that he was prospering so much. And the government just canceled the IPO. And this is an IPO that had international notice. So it was a very interesting step by the government, and started to put investors on edge a little bit. And then later this year, the government shut down an entire industry overnight. Online tutoring in China is very big. Students there, to get into the best high schools, best universities, they need to take these entrance exams. And so for-profit tutoring was a big deal there. And if you were a parent with money, you sent your kids to be tutored so they would do well on those exams. The government saw the difference there, that most people could not afford those tutoring sessions. Shut down the entire industry overnight. That started to concern people a little bit more. They did something similar with online gaming. They restricted overnight. Kids under 18 are not allowed to play video games Monday through Thursday now online. So the government is very willing to do things, at the turn of a dime to reach that common prosperity point. So as we look at China, it's very important from an investment perspective. It's a very difficult country to invest in. It's gotten a lot harder. What you want to make sure you're doing is making sure that you're investing in companies that are aligned with that common prosperity model. So financials, that's been an area that we've had success in the past in China. We don't have any weight there anymore. It's too ripe for the government to become involved. What we do like in China, one thing is semiconductor companies. China is very focused on building its own semiconductor industry. So it is not dependent on any other country for semiconductors. And they're doing that, and they'll do it well. So we've invested in a couple of companies that we like in that space. One is called Sino Wealth Electronics. They make inverters and things like that for the semiconductor industry. We're trying to piggyback on what fits that common prosperity model. So again, as you think about emerging markets, we really think it's coming down to being focused investors and investing in those areas, regardless of where they are in emerging markets, where we think we can have success. So going forward, we'll likely continue to have a very large weight in India, Taiwan. We still like a lot of opportunities there, and we'll continue to be underweight areas like China and Hong Kong. Korea is a more difficult one right now. We'd like to have more weight there, but it's all about finding good companies. And as we look forward, one thing that comes up quite a bit, particularly if you think about the U.S. markets, is stocks have had a great run. It's a very expensive market. How does emerging markets look? We think valuations still look pretty good. As I mentioned, emerging markets really moved sideways for a number of years there. So we're finding lots of good opportunities to find reasonably priced companies that we think can grow over the long term. And what we'll continue to see, I think, in our portfolio from a sector perspective is technology, because you're seeing, particularly in some of these small countries, digitalization is happening. So for example, there's a payments company, kind of like a Venmo in Egypt, that we really like. And it's a homegrown Egypt company where some programmers got together and built this great payments app. And so we're seeing these little stories pop up everywhere. IPO activity in emerging markets is very strong. And again, we're seeing these great small companies bubble up. Now, one thing to keep in mind, though, is that, as I mentioned earlier, there's thousands of companies in this space. And there are a lot of smaller EM companies that just don't meet our quality hurdle. So we continue to do that bottom-up research to look at every company and make sure we're very comfortable with that quality before investing in it. So we're not taking a shotgun approach at all in that sense. So let me stop there and see if there are any questions from the group.
Yeah, can you hear me?
Yes, Marty.
Good. Yeah, I just had a question popped in my mind about something you were saying. I was just curious, with these emerging companies, at what point do they come off the screen, off the radar as a small cap and go into the mid to large, and you pass them on to the next guest that's going to come up and speak to us?
Right, and they may have a different opinion. Market cap ranges kind of vary from manager to manager, but we think of anything in the $5 billion range and below as small cap. And as an investment manager, we won't sell a company just because the market cap grows. So if you look at the weighted average market cap of our portfolio, it's higher than that. It's about $9 billion. And that's because we've had some companies that have grown much larger, but still have that great growth prospect, still high quality. And we think the best thing for you, our investor, is to continue to hold those companies. So new companies coming into the portfolio are typically going to be under $5 billion, but we will have companies larger than that when they grow to that size. Great. Well, thanks again for having us. We really appreciate the opportunity to work on your behalf. We take that very seriously. The last year and a half or so has been a lot of company meetings by Zoom, but I'm happy to announce that Ajay is actually headed to India for most of November. So we're going to start seeing companies again, and we think that's a really good competitive advantage for us to go see those companies and meet with them in person. So thank you so much for having me.
Thank you.
Before Wells Capital presents, I just want to mention one other thing. That Wells Capital recently announced an ownership change. So Wells Fargo, the bank, currently owns Wells Capital Asset Management, and Wells Capital Asset Management is going to be sold to 2 private equity firms. And once that transaction's closed, it'll be called Allspring. So I know that they'll talk about it, but with that, I'll go ahead and have you guys come up.
Hi. First and foremost, thank you for having us here. My name is Michael Warren, Wells Fargo Asset Management. I am responsible for the communications and reporting for your portfolio, and contact with Patty as well as Regina on a regular basis. And with me is Derek Irwin, who's one of the portfolio managers on our Berkeley Street Emerging Markets Equity Investment Team that actually manages your portfolio. So I would say, once again, thank you for having us, and also thank you for the continued trust you've shown in letting us manage your assets and hopefully benefit your retirees. And we don't take the stewardship of your assets lightly, so we genuinely appreciate that. I thought I would just give a brief overview of what Patty began on what our firm's gone through recently and how we've been in the news and why we think it's a positive. And I'll give you from my perspective and how I think it helps me in my job and how I think it helps you. And then I'll turn it over to Derek, more importantly, how it helps our investment managers. And then he can obviously then walk through the portfolio. So if you look at page 4 on the presentation, just to jump in, just a little background. So Wells Fargo Asset Management, owned by right now Wells Fargo, as Patty mentioned, we are being sold. The bank is, over the past year and a half, 2 years, the bank has made a lot of moves. This didn't come as a surprise to us, of selling non-strategic core banking assets. They sold the trust business a couple of years ago, selling our business. That's been a very clear message by Charlie Scharf, who's the Wells Fargo CEO, that they were going to be selling off things that were non-core to commercial and retail banking. So the $600 billion you see there on page 4 that we manage, that in its entirety, and all the management of those, all the investment professionals, all the distribution professionals, all the operations, all the marketing, that all will be in the new entity that will be Allspring Global Investments. And that transaction will close sometime in this quarter, sometime before the end of the year. If you turn to page 5, just a little timeline. So that the transaction to make that sale was announced on February 23rd of this year. We're being sold to 2 private equity buyers, GTCR and Reverence Capital. Like I said, in the whole, as what I do every day, as what Derek does every day, we will be doing the exact same thing we did before. What we won't have is for people to come to you and ask you why you would hire Wells Fargo, given all the headlines that they make on a regular basis, and why we're always in the news for different violations and before Congress. And I can tell you, in all the problems that the bank has had since 2016, none of those have been related to Wells Fargo Asset Management. They've been in different parts of the bank, which is why for us, it's very exciting that we're going to be an independent asset manager going forward. And we will have all the great asset management teams. As you saw on the previous page, we manage fixed income, we manage equity, we manage stable value, we manage a lot of different types of assets across a lot of different independent asset management teams. And those will all be coming over intact. So it's a very exciting day for us. We're going to be able to continue to service our customers without the cloud of Wells Fargo being over us. And for me, sitting in my seat, I think sitting in your seat, that's very exciting. But much more importantly, the bank has obviously been hamstrung by some of the problems it's been through, and I think from an investment standpoint of being able to grow the business and the resources we need to grow the business and perform at our best, I think that our new buyers have a plan and have dedicated a lot of resources toward that. And I'll let Derek talk more about that because that goes directly to the investment teams and having them be able to perform at their best. So I'll turn it over to Derek.
Thank you, Mike, and thank you to the board. I appreciate the time. My name is Derek Irwin. I'm a portfolio manager with the Berkeley Street Emerging Market Equity Strategy. I've been with the firm since 2005, so I have seen a great deal of change with the firm. I actually came from, our strategy was originally part of Wachovia Bank, and when Wachovia was bought by Wells Fargo, we were merged into Wells Fargo, and I have to say, it was a wonderful partnership. We were merged into a great sort of framework and a great business that allowed us to grow our business, allowed us to continue to invest in the way we've always been investing. But undoubtedly, over the last few years, as Wells Fargo, as the bank, has been distracted, I think we've been looking for ways to make sure that that partnership that we've had can continue to grow. And I think ultimately it made sense for us to leave, and I think our new buyers are an incredible opportunity for us, and I am very, very excited. The important thing from our standpoint, and I want to talk about emerging markets more than anything else, but our investment process, our investment team, and all the resources that we have come over with us day one. We miss nothing. Everybody that we've been working with now for 15 years will be working with us the day the deal closes. So from our standpoint, it is a very smooth transition. And in fact, it's clear to us that our new owners are very interested in investing in this business. They are not interested in stripping this business for parts. They're going to create value by growing this business. And I'm very, very excited. As I like to say, we've gone from being a small fish in a very big pond at Wells Fargo to a big fish in our very own pond. And I like that. I think it feels really good. So I'm happy to answer any questions on that, but maybe what we could do is jump into the emerging markets and the strategy and give you a sense of what's been going on. Thanks to Wasatch for laying out some of the bigger picture issues very, very clearly, so I appreciate that. Maybe saves us a little bit of time. But I do think it's important that we look at emerging markets a little different, and of course we play in a slightly different sandbox than the small cap strategy. So the market cap range in emerging markets goes from very, very large, almost trillion-dollar companies, right, down to $100 million companies. And we play more on the larger, more liquid area, and that's generally good, but has its own dynamics. So hopefully we can talk a bit about that. We'll give a quick overview of how EM has sort of survived the pandemic and how it's come through and where it stands now. And then I want to focus on the recent period, because as you mentioned, it has been a very volatile period for emerging markets. I completely agree with the concept that emerging markets is coming off of what had been in the early part of the last decade, a fairly flat, lackluster period. But that takeoff is going to be volatile, and we saw that in spades in Q3. And I think understanding the last quarter will really help us understand how to think about emerging markets going forward. And then finally, we can talk about positioning and outlook, and I'm happy to answer any of your questions. Why don't we do this, maybe page 7, if we could. Oh, well, there we are. Just a brief overview of the strategy. So the Berkeley Street Emerging Market Equity Strategy at the end of the quarter, managed about $13.5 billion. And we have three, what I would call flavors, or within that, we have our all-cap flagship strategy, which spans the entire market cap spectrum of emerging market equities. And then we have the large and mid-cap strategy, which we started in 2012, and is what you are invested in as a complement to Wasatch. We also have a small cap strategy. It's very new. We've been running it now for about 3 years as a seed portfolio and just got our first institutional investor this year. So we're very excited with how that's coming along. But for today, we're focused on the larger end of the spectrum and the larger companies, many of which you'll probably be familiar with. Maybe we could jump to page 9, just a little bit of history here. And you can see on the top left, we give a little bit of market information over the last quarter, the last year, and the last 3 years for the overall emerging markets. And this is looking at the Msci emerging market benchmark. And what you can see is over the last year, a pretty good rebound, about an 18% rebound, despite a pretty challenging last quarter. And that understates it a little bit, in part because emerging markets began to come out of the pandemic a little bit earlier. So whereas I think in the West we focused on vaccines and the science-driven ways of managing the pandemic, China and its Asian neighbors in particular really shut down and very quickly brought the pandemic under control, and as such were able to open up their economies much more quickly, and we saw an earlier rebound, and quite a strong rebound out of China. The big difference, though, and it's making a difference in emerging markets now, is that whereas the US and Europe stimulated their economies very aggressively, as all of you are aware, China and Asia and much of emerging markets certainly poured on the stimulus, but nothing to the same effect. They just don't have the resources, and China focused on doing it in a different way. And that's having an effect now. So the way I look at emerging markets and the global recovery from the pandemic is a bit of a relay race, right? China and its Asian neighbors kind of took the baton early on for recovery from the pandemic. And as such, we saw their markets doing well. We saw their economies growing very fast and recovering very quickly. And then they passed that baton on to the developed markets, who once we had the vaccine and got the pandemic largely under control and were able to open our economy, really supercharged our economies. And that stimulus really played a big, important part. So starting at about the beginning of 2021, we saw the US and Europe really taking over global growth. And the way that I saw this playing out was China leading that sort of early stage, passing the baton to the US and Europe, and then passing the baton to countries like India or like the rest of EM, which were lagging in terms of opening up. That's obviously been delayed a little bit with the Delta variant. So while the US and Europe are really more than carrying their weight globally, the rest of emerging markets really are just now opening up. And I think that's important. What we've also seen, and you can see in Q3, and this is very important, that as the Asian economies began to normalize, right, just like we'll see in the US. The US is very strong growth, but that will normalize. China's doing that ahead of time. Asia's doing that ahead of time. So we're seeing those economies slow into a more normal growth, while the rest of the world, of course, is growing very strongly, to the point where I think it's fair to say there's pretty significant concerns over inflation, over whether the Fed will have to raise rates or whether emerging markets will have to raise rates. And I think that's created some significant concern amongst emerging market investors that we're going to see a hard landing in emerging markets. And then, of course, as Wasatch mentioned, we had that significant crackdown in regulatory activity in China that compounded that, and we saw a significant drawdown in China. So you can see China, particularly in the last quarter, and Brazil, the two big underperformers, right? But over 1 year, pretty good broad-based recovery. And then over 3 years, actually emerging markets is hanging in there. We're not quite ahead of the US, which has been turbocharged, but ahead of Europe and ahead of a lot of the rest of the world. And I think it's important to keep that in perspective. Which I guess leads us to where we are now and the portfolio. You'll see your portfolio on page 11, and then on page 12 is some of our performance. And I'm sad to say, the third quarter was not a good quarter for us. Actually, it was our worst quarter in the strategy's history. We came off of 2.5 years of very strong performance, where in fact we outperformed the benchmark by a cumulative 20%. The portfolio, in our view, was and remains in very good shape, but we were impacted by some of those, particularly regulatory activities, and then some of the concerns over the global slowdown. And I want to really focus on those and should give you a sense of where our positioning is and how I think this plays out as we go forward. So briefly on page 13, you can see when we talk about regulation and the flurry of regulatory activity, it's not an exaggeration at all. This is a chart that Goldman Sachs put out as sort of a proxy for private sector regulation in China. And you can see starting at about 2020, at about the time of the Ant Financial IPO, a huge increase in regulatory activity in China. Basically, China looked at the world, said, we are growing very fast out of the global pandemic. We have, by their standards, eliminated poverty, which is a fair, by looking at the targets they've set, which is fairly true. And we want to use this window to now take that growth that we've seen and share that growth with the entire economy. And that's had some friction. I frankly think it's created more fear amongst international investors than actual real economic impact. But certainly, particularly the larger liquid names, which you would be familiar with, Alibaba, Tencent, household names even over here, bore the brunt of that. They bore the brunt of the regulatory impact, but they also bore the brunt of foreigners selling. And it, to me, speaks to the dangers of thinking about China and thinking about emerging markets or investing in general as a story, right, or as a theme. We are bottom-up investors, and the companies that we own, we know extremely well. So when these regulations were put in place, we were able to evaluate the economic impact very quickly and understand what this really means for our companies. So for instance, if you look on page 15, the biggest detractor in Q3 was a company called Bilibili. Now, Bilibili is probably up 10 times since we bought it. A tremendous company. They do two things. They do social media, kind of like a YouTube, and they distribute games. As Wasatch mentioned, there was a significant crackdown on how much time children can play games in China. And naturally, as a game producer and a game distributor, investors overseas looked at that and said, I think we're going to sell that company. That must be terrible for Bilibili. Well, in fact, gaming revenues make up about 27% of their revenues. But if you look at children's revenues, so 16 and younger, which were the people who were impacted by the regulatory, it's less than 5% of their revenues. China is already a highly regulated industry. So I think investors, particularly overseas, looked at these regulations, said there's some sort of war on capitalism, or China is trying to take over the private companies. It's not the case. And so we can look at these companies and understand where are the drivers of value. What is really happening to these companies? And it's allowed us, I think, to ride through what has been a very rough storm, but one that I think is creating interesting opportunities in China and elsewhere in emerging markets. The other interesting challenge in the portfolio, and I think this speaks maybe more broadly globally, but it happened to hit Brazil because Brazil is a country that really normalized quickly. They had to raise rates in the face of inflation. They have a terrible presidential election cycle, and the currency's been quite weak. But what we've seen is Americanas, very interesting company. They're an e-commerce company, right? Very much like Amazon. There are basically 3 large e-commerce companies in Brazil. And Brazil probably was the most positively impacted in terms of their e-commerce industry by the pandemic of anybody else in the world. They just happened to be at the right place. Infrastructure was in place, the competitive dynamics were in the right place, the access to technology was in the right place, and these stocks took off, which was great, and we were benefited from that. But it also, in a world where capital, awash with capital, attracted competitors. So over the last few months, we've seen Alibaba from China come in, Shopee, which is owned by Msci, out of Southeast Asia, come into the market, and there's concerns over competition. Again, we understand where this company and its competitors sit, and we understand the competitive threat that folks like Alibaba, who we've known for decades, and folks like Shopee, who we know very well, present to these companies, and we think it's smaller than they think. So we think there has been an overreaction, but it is a reaction nonetheless, and it has had an important impact on the portfolio. Which I guess leads us to how we've managed that, and I'm going to jump, and how we think this plays out. And I'm going to jump to page 20 on that, very briefly. And I think that a few things really stand out to me that we're really focused on. What's happening with the Chinese economy? Is the Chinese economy going to slow down or crash? We haven't even talked about the Evergrande real estate issue. Is there a fundamental flaw in China, and are we going to see a significant slowdown? I think the answer is no. I think it's very clear the Evergrande issue is not a Lehman moment in any way. The banking system in China is more than able to manage that issue. In terms of an economic slowdown, certainly, I think we've seen an economic slowdown. But as I said, China didn't stimulate nearly as much as the US, and it leaves it with dry powder. And we already see stimulus growing. And so the chart on the top right of page 20 is a repo injection, a form of liquidity injection into the markets, has already begun to grow. We saw a cut in the required reserve ratio, which is another measure of bank liquidity in China, and we would expect to see interest rates cuts and other stimulus out of China that may well lead to a growth surprise in China. And I think that right now, given the relatively negative view on China and Chinese growth, that could be a significant surprise. The second is, how do we think about inflation and tapering by the Fed? In 2013, if you recall, when the Fed suggested they might someday begin to taper, emerging markets fell very, very sharply. And the concern is, if the Fed does that again, will this happen again? Will we have a repeat of the taper tantrum? What I will say there is that emerging markets are in a much different place than they were in 2013. You can see on the bottom right side of the page, this is current account deficits, so a measure of external vulnerability or vulnerability to tapering. And you can see they have closed. A negative current account deficit is very bad for companies when we see liquidity go out. And in 2013, countries like Turkey and South Africa and Brazil and Indonesia were so bad that they got their own term called the Fragile Five. And all of those countries and most of emerging markets now see their current account deficits and their vulnerability to tapering significantly lower. So we think that risk is overstated. How do we handle this? Really through a very diversified portfolio. So over the last year, as China performed extremely well up until this quarter, we were taking money out of China and on the margin putting it into Latin America, Mexico in particular, which is our largest overweight, a little bit in Brazil, and then a little bit in Russia, and then a little bit in India. And so we've been diversifying this portfolio, but again, that diversification starts from the bottom up. Two things I will note: we do remain roughly equal weight China. And I think for the reasons we've just discussed, it's very easy to want to go underweight China and to look at China as a problematic economy. That's not the case. In the companies that we own, we believe are in good shape and cheap. So maybe I'll leave it there. I'd probably have gone too far, and open it up to any questions you have.
Oh, that was loud. Can you hear me?
Yes.
Right here. This term taper tantrum, I've heard that before. Could you expand on that a little bit?
Sure. So when, particularly the Fed, but global central banks in general, right, release liquidity, lower interest rates, or the various quantitative easing that the Fed put in place both after the global financial crisis as well as in during the pandemic, right? That liquidity and that money, right, flows into places like emerging markets. We say that goes into riskier assets, which is unfair, but we'll go with it, right? And that's great. The currencies do well, bonds do well, right? The stocks do very well, right? But then the worry is when that comes out, does it expose vulnerabilities, right? So if I have a current account deficit like Turkey had back in 2013 at 6%, right? I have to come up with 6% of my economy of inflows to pay for all that outflow, right? And if the whole tide is going out, that's pretty hard to do. And so Turkey, not surprisingly, fell very sharply in that period. But as those current account deficits fall, I don't have as much that I need to pay as that tide comes out. So I'm much more able to weather that storm. A current account deficit is basically your trade deficit and your financing deficit, so if I'm borrowing from overseas. So the governments are in much better shape, currencies are in much better shape, and I think that our currencies are certainly much cheaper than they were as well. So we're less concerned about that. I think that the next few months, probably a lot of volatility. When the Fed meets in November, we'll see volatility. When the Chinese start to ramp up to their big meeting in 2022, probably some volatility. But I think markets are very well positioned to ride that volatility out.
The recent saber rattling in Taiwan and recent comments by the Chinese government about reunification, does that impact your investment strategy in Asia?
So, look, I think that's a very important long-term sort of base note that we're going to be dealing with in China for a long time. You know, I think that the regulatory issues, that'll go away. But the reality is we have a fundamental there's a fundamental at odds between the West, and particularly the U.S. and China, that's going to be extremely difficult to manage over time. So I don't want to understate that. I think, though, that unlike, say, with the Cold War, right, where you effectively had two separate economic orbs, these economies are so tied together, it's very hard to disentangle them. And it's very hard, especially to violently disentangle them. But it is a real risk, and one that's, I think, almost impossible to quantify, right? Could we wake up tomorrow and China's invaded Taiwan? It's a very real risk. I think realistically, they're probably many, many years away from being able to do that, 5 years or so, but it's a goal. So this is something as emerging market investors we have to take into account. What's interesting about this, where we stand now, right? So as many of you know, the former administration put in significant sanctions against Chinese companies, and in fact, some of the companies that we owned, we had to sell. China Mobile, for one, because they were deemed controlled by the Chinese military, et cetera, et cetera. And that tension and those sanctions have continued into the Biden administration, part and parcel. And we view that as a pretty negative thing, and it's certainly a risk, and it's certainly a source of tension, but it's actually created some pretty interesting opportunities. In fact, one of our best performing companies over the last year, for sure, is called Li Ning. And Li Ning is the Nike or Adidas of China. They make sportswear. Li Ning was a gymnast from the 1980, the LA Olympics. Is it 80 or 84? I can't remember. And wonderful sort of very high quality products, sneakers, clothes, et cetera, really great stuff. But always competing with that sort of desire for international brands. And that desire is cooling rapidly. So as I think the friction with the West continues to ramp up, Chinese consumers are looking toward local brands, as I like to call it, Chinese brands for Chinese people. And so companies like Li Ning really benefit from that. So it creates winners and losers.
Okay. Thank you very much.
Thank you for your time.
Okay, moving right along. Item number 3 on our agenda is to approve the minutes of September 9th, 2021. I have a motion and a second. Please record your vote. Item passes. Item number 4 is the consent docket. we have two items that we can take with one motion. I have a motion and a second. Please record your vote. Item passes. Item number 5 is to ratify approvals. I have a motion and a second on item 5. Please record your vote. Item passes. Item number 6 is to approve the claims docket. I have a motion and a second on item 6. Please record your vote. Item passes. Item number 7 is approve the following applications for service retirement. I have a motion and a second. Please record your vote. Item is approved. Item number 8, receive report of death, authorize payment of the $5,000 death benefit, and approve continuation of the pension to the spouse. I have a motion and a second. Please record your vote. Item is approved. Item number 9, receive report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. I have a motion and a second. Please record your vote. Item is approved. Item number 10 is to receive report of death, authorize secretary to make necessary changes to conform on the following. I have a motion and a second. Please record your vote. Item is approved. Item number 11 is to receive report of death, authorize, approve continuation of pension to the spouse. I have a motion and a second on item 11. Please record your vote. Item is approved. Item number 12 is to approve the following to terminate vested rights and receive a lump sum payment of employee contribution account. I have a motion and a second on item 12. Please record your vote. Item is approved. Item number 13 is items for individual consideration. We have one item. 13A is the renewal of our agreement with Asset Consulting Group, LLC, for investment consulting services for the period of January 1st, 2022 through December 31st, 2026. Annual retainer fee ranging from $185,000 to, to $220,000 per year. Anyone have any questions? No? Chair, I'll entertain a motion. Have a motion and a second. Please record your vote.
How would you like to vote?
Item is approved. Item number 14, 14A is our investment consultant report.
Good morning. Thank
Good
you
morning
for
again.
approving our contract extension. I always say that. Just a few comments on the two managers this morning. First off, you did hear from Wells Berkeley on the transition of ownership. That's something that we've been talking to them about for some time now. I have to say, internally, we've always referred to that strategy as the Berkeley Street strategy. Wells Asset Management had a number of boutique asset managers that they had acquired over time, and they let them pretty much operate autonomously within the Wells umbrella, with Wells Asset Management providing marketing and distribution. We do view this as a positive, the acquisition by the private equity managers to really spin them away out of the bank and the noise that the bank has that really doesn't relate to anything going on with asset management. So we view this as a positive and just a continuation. Nothing's changing with the Berkeley Street team that manages your money and the process in which they go about it. Allspring Asset Management. So it's really the participants, each of the investment teams, they're going to have an ownership stake. They're going to have ownership in the new entity along with the private equity firms that are purchasing it. With respect to the allocation, the 5% allocation, as Patty mentioned at the beginning, it's really split between the two firms, with Wells, the mid to large cap, the more stable companies, if you will, in a very volatile asset class. That's intended to represent about 70 to 75% of the EM, and then Wasatch investing in smaller cap companies about 20 to 25% of the emerging market allocation. To Jim's question about geopolitical or regional political issues, that is always a concern within emerging markets. And that's why, from an allocation standpoint, we allocate only 5% to emerging market equities overall. That's how you're controlling that risk. And then implementing it through multiple managers that are doing some different things, and then giving them the ability and the discretion to move in and out of sectors. I don't think we would ever anticipate either of your emerging market managers abandoning a country altogether that represents as large a portion of global markets as China, but it's something that that they're navigating. Over the last year, it's been beneficial having these two complementary managers, because where the index is about 36% China. The EM index is about 36% China. The small cap emerging market index is much less than that. And as you see, Wasatch has a much lower exposure to China and a much larger exposure to India. And so that helped offset the challenging performance, particularly of the last quarter in the Berkeley Street strategy. And overall, your emerging market allocation, the combination of those two managers, outperformed the emerging market benchmark by about 6.5% on a trailing one-year basis, even with Wells having the worst quarter in the history of the strategy. And it's not always going to work out perfectly like that, but that's why we have the diversification in the portfolio. Just looking at the overall portfolio, September was a down month, really ending a down quarter. It was pretty challenging in the markets over the last few months. That said, the one-year returns are still very strong. The one-year period ending September, the fund is up just a little under 20%, 19.82 gross of fees, 19.3 net of fees, and about 50 basis points ahead of the policy index, and well ahead of your hurdle rate of 7% over that one-year period. If we look down that row, certainly very robust returns still on a one-year basis across every asset class. Large cap roughly in line with the benchmark. Small cap trailed a bit. We've talked about that this year, particularly in the beginning of the calendar year, January, February, and going back a little bit into December. We really saw lower quality companies in the index outperforming companies that had earnings quite substantially, and your managers, fundamentally oriented managers, high quality focused, not owning the names that were up dramatically that have no earnings and potentially on the brink of bankruptcy were it not for some retail investors plowing money into them. So your small cap's up close to 40%, and that trailed the benchmark, but that's really where that's coming from. Within the long-short equity allocation, protected relative to global long-only markets in the month of September, down about 1.8% versus the ACWI, which is a global benchmark, down 4% in the month. So you did get that protection. On a one-year basis, trailing the ACWI, global long-only benchmark, which we would expect, trailing a peer group of other equity-oriented hedge funds by about 4% in that one-year period. It's really a couple of managers, one healthcare manager throughout. You have 12 managers in the portfolio, a healthcare manager and one very concentrated manager, Tremblant, that had really it's kind of the story of low quality outperforming high quality that we see in small cap. We're seeing that in some of the long short equity managers as well, and that's leading to a little bit of that not up as much as broader markets. Your private equity allocation, a very strong year. The period, really the June 2021 marks on private equity funds that you don't see until August and September that flow through, very strong. We're seeing some of the strongest returns across private equity, specifically venture capital, that we've seen in really going back to the late 90s and the tech boom, really pushing up returns. Your return for your overall private equity allocation up 43.5% on a trailing 1 year. Again, if we look at that compared to the S&P, which is up 30%, about a 15% premium, so very strong returns. Just for the month, on a cash flow basis, in the month of September, we had 1.1 million in outflows, meaning that's new fundings, and you received a little over $1 million back. A large distribution of $700,000 from Msci, which is a fund of funds, one of your first fund of funds investments, made a large distribution back. Also, Warburg Pincus 11 and 12, which are more recent funds. These are a 2012 and a 2015 fund, had distributions of 140,000, two distributions of a little over 140,000. I believe your First Mark Capital Opportunities Fund 3, which is a 2020 fund, has just made a distribution in the last few days back to you, and that's around 100,000. But those distributions, as they sell companies or companies go public, that money's coming back to you. But also what we're seeing in that 43.5% return number is just right markups in valuation due to really strong company performance. The international developed portfolio, again, strong returns up close to 24%, a little bit behind the benchmark. Similar story on the growth side, at least for Harding Loevner. It's been lower quality outperforming high quality in companies, and that your managers just don't own as much of that. Fixed income, talk about this a lot, while certainly much more modest, and we're talking 2.6% returns on the year. That's really strong outperformance from active management in a period of time where we've seen rates going up and broad bond market returns are negative. So as rates go up, bond market returns go down. The benchmark, primarily treasuries, higher quality treasuries, much more sensitive to rate movements. Your managers, Western on the Core Plus side, PGIM, absolute return, and then Brandywine, a non-US strategy, really able to navigate the global fixed income markets, adding that positive return. And then finally, the overall real estate on a one-year basis up a little under 7%. Did have some cash movements in the month of September. We raised $22 million to fund. You had a $14 million additional subscription to the Morgan Stanley Prime Property Fund, which was funded, I believe, at the end of September. So it's reflected in these numbers. And then we raised that from large cap and small cap, which has been overweight, to bring that down a little bit. And then we worked with staff to make sure that we have enough cash really to get you presumably through the end of the year for operating needs, for benefit payments, as well as capital calls that we're expecting. And the capital call activity has picked up as you've made more commitments both to private equity and private real estate. That is picking up a little bit. So we're holding a little bit more cash. That said, we're able to raise cash in this portfolio very quickly. There's no liquidity concerns. It's a very liquid portfolio. That.
Any questions for Jason? Okay.
Thank you.
Thank you, sir. Item number 15 is comments from board, staff, and citizens. I just want to remind everybody that's planning on going to lunch that the lunch is, I guess it starts at 11, right?
Yeah, I think we can probably go straight from here over there.
Go over to Flint. Thank you, ACG, for hosting the lunch. Unfortunately, I'm not going to be able to make it. I've got another commitment I've got to go to this afternoon, but if you can make it, they do have good food over there. I've eaten there several times. And I see our counselor approaching the bench with some comments, so.
I just want to remind everybody that while we're going over there for lunch, we're not going to discuss any business, because the public meeting should be over, and we're going for the socialization and the education.
So noted. Thanks for the reminder. Any other comments for the good of the cause?
Well, just one quick comment, Jason. Very pleased that we were to have you for another 5 years. Everything I've heard about your firm and your services has been exceptional, and I think it'll be great going forward.
Okay, with that, we are adjourned at 11:02. Thank you, everyone.